Most investors think buying NVIDIA means they're exposed to AI. It's not that simple. NVIDIA is one company inside a massive, multi-trillion-dollar supply chain that includes chips, memory, networking, power generation, cooling systems, and cloud computing. In this video, we're going to map that entire ecosystem, show you the companies most investors have never heard of, and then build an actual AI portfolio together. By the end, you'll understand not just who's winning in AI, but how to structure your own exposure intelligently, instead of betting everything on one ticker symbol. Here's the mistake almost every AI investor makes. I bought NVIDIA, so I'm covered. But NVIDIA is just one link in a very long chain. Think about it like owning a car company's stock and assuming you're exposed to the entire auto industry, tires, steel, dealerships, gas stations, all of it. You're not. NVIDIA makes incredible chips, but chips need memory, networking, power, and cooling to actually function inside a data center. Owning one link isn't the same as owning the chain. Let's look at exactly what that chain costs you when things go wrong. A single stock bet means your entire return depends on one earnings report, one export rule, or one competitor breakthrough. And even great companies get hit hard. NVIDIA itself dropped 66% in 2022, despite being a phenomenal long-term business. That's not a flaw in the company, that's just what concentration risk looks like. Diversification isn't about being cautious or timid, it's about building structure into your portfolio so no single headline can wipe out years of gains. Now let's actually see what that full ecosystem looks like. Here's the framework we're going to use for the rest of this video. The AI stack. 6 layers, working together. Chips at the foundation, then memory, then networking to move data between chips, then power to run it all, then cooling so it doesn't overheat, and finally cloud and software, where AI actually gets delivered to businesses like you and me. Every single layer creates its own investment opportunities. Keep this stack in your head, because we're going to climb through it layer by layer, starting with the one everyone already knows. Let's start with chips, the layer that gets 90% of the media attention. GPUs and custom silicon are essentially the engine of AI. They're what actually run the calculations behind every model. This is where NVIDIA lives, and it's genuinely the most important layer to understand. But here's the thing. It's only one of 6 layers in this stack. If you stop your research here, like most investors do, you're missing 5 entire categories of opportunity. Let's talk about why NVIDIA earned its spot at the top. NVIDIA controls roughly 80% of the AI training chip market, and that dominance isn't an accident. Their real moat isn't just the hardware, it's CUDA, their software ecosystem that developers have built entire careers around. Switching away from NVIDIA isn't just expensive, it's disruptive. That said, the stock is priced for near perfection, and a huge chunk of revenue comes from a small handful of customers. A great company isn't automatically a great investment at any price. When dominance is this extreme, competitors start racing to close the gap. Enter AMD. Their MI300 and MI400 chip series are competing directly with NVIDIA for AI training workloads. And here's something important. The big cloud companies actually want a second supplier, because relying on one vendor gives that vendor enormous pricing power over them. AMD's AI revenue base is still much smaller than NVIDIA's, which sounds like a weakness, but it actually means more room to grow percentage-wise. Think of it as the challenger with less to lose and more upside if it executes. But none of these chips get built without one specific company. Here's a name most retail investors have never heard of, despite it being arguably the most important company in the entire AI supply chain, TSMC. They manufacture the vast majority of the world's advanced AI chips. NVIDIA, AMD, even Apple, they all depend on TSMC's factories. That creates a real risk, though, because most of that manufacturing capacity sits in Taiwan, which adds a layer of geopolitical exposure you don't get with a typical tech stock. Understanding TSMC is understanding the actual choke point of this entire industry. Broadcom plays a quieter, equally critical role. Broadcom doesn't get nearly the attention it deserves. They build custom AI chips, called ASICs, specifically for hyperscalers like Google, and they also make the networking chips that move data between GPUs inside a data center. On top of that, their revenue is diversified well beyond pure AI hype, which makes them a bit more resilient than a pure-play chip stock. This is exactly the kind of company that rewards investors who dig past the obvious headline names. Now let's talk about what those chips actually need to work at all. Memory. Here's a bottleneck almost nobody talks about. AI chips are essentially useless without high bandwidth memory, HBM, sitting right next to them. And right now, demand for that memory has driven prices sharply higher, creating real supply shortages. This layer moves in lockstep with chip demand. When chip orders go up, memory orders go up right behind them. Most top AI stocks, videos skip this layer entirely, but it's just as essential as the chips themselves. One company controls a huge share of this supply, and it might surprise you. Micron is one of the major suppliers of high-bandwidth memory for AI servers. Memory pricing is historically cyclical, and right now we're sitting in an upcycle, which has been a major tailwind for the stock. But be aware, memory stocks tend to be more volatile than chip stocks. This is genuinely a higher risk, higher reward name in the ecosystem. It's a great example of a company most investors have never considered adding to an AI portfolio. Now the data has to actually move somewhere, and that requires serious networking infrastructure. AI training isn't one chip doing math in isolation, it's thousands of chips talking to each other in real time, constantly. If the networking between them is slow, the entire cluster slows down, no matter how powerful the individual chips are. This is genuinely the plumbing layer of AI, and it's infrastructure that almost no retail investor ever thinks about, because it's not flashy. But without it, none of the previous layers actually function together at scale. One company has quietly become essential to nearly every major AI data center on the planet. Arista Networks builds the high-speed switches used inside hyperscale AI data centers, and their customer list includes basically every major cloud provider you can think of. It's less sexy than a chip stock, which historically has meant a less crowded trade with less hype baked into the price. This is a perfect example of why thinking in terms of the whole ecosystem, not just the loudest headlines, uncovers opportunities most investors walk right past. All of this hardware needs something even more basic to function: electricity, and a massive amount of it. Here's a number that surprises most people. A single large AI data center can use as much power as a small city. That's not an exaggeration, it's a real engineering constraint. US grid capacity is genuinely becoming a bottleneck for how fast AI infrastructure can actually be built. Power has quietly become a strategic AI investment theme, even though it has nothing to do with chips or software directly. This has turned a sector nobody associates with AI, utilities, into an unexpected beneficiary of the entire boom. Constellation Energy is a nuclear power provider that's been signing direct deals with hyperscale cloud companies to power their AI data centers. Nuclear gives you reliable, 24/7 power, which is exactly what's critical for facilities that literally cannot afford downtime. What's fascinating here is that a traditionally boring utility stock has been re-rated by the market specifically because of AI demand. This is the kind of lateral thinking that separates a surface-level AI investor from someone who actually understands the full picture. But all that power creates a very different problem: heat. AI chips generate enormous heat under sustained, heavy workloads, far more than traditional computing hardware ever did. Standard air cooling simply can't keep up with next-generation chip density anymore. That's why liquid cooling is quickly becoming the new standard inside AI data centers. It's not optional, it's a requirement for scaling further. This layer completes the hardware side of our stack before we move into software and cloud. One company has become the clear go-to name for solving exactly this problem. Vertiv is the leader in data center power management and liquid cooling systems, and they're a direct beneficiary of the industry-wide shift toward high-density AI server racks. Their order backlog has grown sharply as this AI build-out accelerates, which tells you demand is real and sustained, not speculative. This is genuinely one of the most overlooked names in mainstream AI coverage, and that gap between attention and importance is exactly where opportunity tends to hide. Now let's zoom out to where all this hardware actually lives and gets used. Companies don't want to build their own data centers, so they rent AI compute instead, and that's where cloud computing comes in. This is the layer where cloud providers capture value across the entire stack we've just walked through: chips, memory, networking, power, cooling, all of it gets bundled and sold as a service. This is also where AI stops being pure infrastructure and starts becoming an actual product businesses use every day. Two companies dominate this layer, and they're doing it in very different ways. Amazon Web Services remains the largest cloud provider on the planet, and their AI angle is smart. They've built custom chips called Trainium and Inferentia specifically to reduce their dependency on NVIDIA. AI here isn't a separate business, it's a growth layer stacked on top of an already massive, highly profitable cloud business. This shows how a company most people think of as just a boring mega cap is quietly one of the largest AI infrastructure plays in the entire market. Microsoft took a different, arguably bolder approach. Microsoft made a deep partnership and investment stake in OpenAI, and then embedded that AI directly into Office, Windows, and Azure, tools hundreds of millions of people already use daily. Their angle is monetizing AI at the software layer, rather than purely through infrastructure like Amazon. It's a completely different investment thesis, betting on distribution and integration rather than raw compute. Two mega caps, two totally different ways of capturing AI value. So far we've covered 9 companies. Here's a category almost nobody talks about. Let's widen the lens even further. Industrial rights actually lease the real estate that AI data centers physically sit on, collecting rent regardless of who's using the compute inside. Grid and transmission infrastructure companies benefit as power demand surges. Even water utilities benefit, since massive amounts of water are used in cooling systems. None of these show up in a typical AI stocks list, but they're all genuinely riding the same wave. Now that we've mapped the winners, let's talk honestly about what could go wrong. Here's something that might surprise you. You may already own a concentrated AI bet without realizing it. The Magnificent Seven now represent a very large share of the S&P 500's total weight. So if you think a broad index fund automatically makes you diversified, you might want to double-check that assumption, because it may already be quietly loaded with AI exposure. Diversification requires actually checking your holdings, not just assuming a fund name means safety. That concentration cuts both ways, so let's talk about the real risks. Let's be balanced here, not hype-driven. AI capital expenditure growth could slow down faster than the market currently expects. That's a real risk. Valuations across almost the entire ecosystem are elevated right now, not just NVIDIA. And competitive disruption is always possible. Cheaper chips or entirely new architectures could reshape who wins. I'm not telling you this to scare you away from the sector. I'm telling you because a responsible analysis has to include the downside, not just the upside. So how should a disciplined investor actually respond to all of this? Owning just one layer of this stack means you're essentially betting that one specific narrative stays true. Owning the whole ecosystem means you're betting on AI adoption itself, a much broader, more resilient bet. Diversifying across layers, chips, memory, networking, power, cooling, and cloud reduces your exposure to any single company's bad quarter or bad headline. This is exactly why we built that 6-layer framework earlier. It's not just educational, it's the actual foundation for how you should think about building a portfolio. There are 3 ways to build this exposure. Let's compare them. The simplest option is a broad-based AI or semiconductor ETF. In one single trade, you get exposure across the ecosystem, and the fund automatically rebalances as the landscape shifts. It's lower effort and requires much less ongoing research on your part. The trade-off is that you give up control over exactly how much weight each individual company gets inside your portfolio. For investors who are busy, or just starting out, this is a completely reasonable place to begin. For those who want more control, individual stocks are the alternative. If you want more control, you can handpick companies across each layer of the stack yourself: chips, memory, networking, power, cooling, and cloud. This gives you the ability to size positions based on your own conviction level. But it requires ongoing monitoring, earnings calls, competitive shifts, capital expenditure trends. This isn't a set it and forget it approach. It's higher potential reward, but it's also a real-time commitment. Most investors don't actually need to choose one extreme or the other. Here's the approach I genuinely use myself. This is the framework I'd actually recommend: core satellite. Your core position is a broad ETF, giving you stable, diversified exposure across the whole ecosystem. Your satellite positions are a handful of high-conviction individual stocks layered on top, giving you extra upside where you have strong reasoning. This balances the simplicity of an ETF with the targeted potential of stock picking, without requiring you to choose one approach exclusively. It's genuinely the most practical framework for most intermediate investors. Let's put real numbers behind this so it's actually usable. Here's a sample allocation to make this concrete. 60% in a core AI or semiconductor ETF, your foundation. 15% in the chip layer, specifically, NVIDIA and AMD combined. Another 15% spread across the infrastructure layer, names like TSMC, Vertiv, Arista, and Constellation. And 10% in the cloud and software layer, Microsoft and Amazon. This isn't a rigid formula, it's a starting template you can adjust based on your own conviction and risk tolerance. One more question before we wrap up. How much AI is actually too much? Your AI exposure should reflect your actual risk tolerance, not FOMO from watching the stock charts. And remember what we covered earlier, your existing index fund might already carry significant hidden AI weight through the Magnificent Seven. As a general guideline, a satellite allocation like the one we just built typically makes sense at somewhere between 5 and 20% of a fully diversified portfolio. Go higher only if you genuinely understand and accept the added volatility that comes with it. And because this sector moves fast, your portfolio can't just be set and forgotten. The layers that dominate today, mainly chips, may shift toward others, like power or cooling, as this cycle matures and infrastructure catches up to demand. That's why it makes sense to review your AI allocations every 6 to 12 months, not constantly, but consistently. And when you do rebalance, base those decisions on fundamentals, earnings, capital expenditure trends, competitive positioning, not on headlines or short-term price swings. This keeps you disciplined instead of reactive. Let's bring everything together with the biggest takeaways from this video. Let's recap the biggest opportunities we've covered today. The AI ecosystem is genuinely broader than any single headline stock, spanning 6 interconnected layers. The infrastructure layers, specifically, power, cooling, and networking, remain some of the most underappreciated parts of this entire story. And because the ecosystem is so broad, there are meaningful entry points across almost every risk level, from a conservative ETF core to higher conviction individual names. That's the real opportunity here, breadth, not just one dominant stock. But let's be equally clear about the risks. And here are the risks, stated plainly. Valuations across most of this sector are elevated right now, not just for NVIDIA, but broadly. The capital expenditure cycle that's fueling this entire build-out could slow down faster than currently expected. And there's real geopolitical exposure tied to Taiwan and export controls that could disrupt the supply chain with very little warning. Understanding these risks before chasing the opportunity is what separates a disciplined investor from someone chasing headlines. So what should you actually do with all of this? Here are the core lessons to take with you. AI is an entire ecosystem, not a single stock, and treating it that way changes how you should build exposure. Diversify across the layers we covered today, not just across company names within the same layer. And most importantly, match your AI exposure to your actual risk tolerance, not to excitement or fear of missing out. These 3 lessons alone will put you ahead of most investors chasing this trend right now. Here's exactly how I'd put this into practice starting today. Don't bet on one company, invest in the ecosystem. That's really the entire message of this video, distilled into one sentence. AI is going to reshape entire industries over the next decade, and the investors who understand the full stack, not just the loudest headline, are the ones who will be positioned to benefit from it responsibly. If this helped you think differently about AI investing, subscribe, because next up, we're building a complete sector diversified growth portfolio from scratch, applying this exact same framework.